Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right, now let's get into Vega. Vega is the Rodney Dangerfield of the Greeks, if you will. It tracks volatility, and a lot of people disregard volatility in option contracts. But Vega is the amount an option's theoretical price will change for a corresponding 1-point change in the implied volatility of the option contract. The more time premium, the higher the Vega is for an option. By that rationale, longer-term options will have a higher Vega than shorter-term options. All right, so if we looked at a strategy and the sound stopped, can you guys hear me? Hello? One second.
Yes, I can hear you, Brian. I can hear you.
Okay. I think my phone's going to die. I'm in the middle of the webcast. How do I get on line 1? Hello, Steve, can you hear me?
Yep, got you, Brian.
I just had to switch phones. Battery was dying on our...
Good handoff.
Yeah,
That's great.
I apologize.
No problem. That's great.
Okay, it was a great save, though. I switched.
Yeah, absolutely. We're good.
Batteries. Okay, so now, when we're looking at Vega, this is another one that I want to talk about in a strategy, and I want people to think about this. If we're looking at advanced strategies, and you're thinking about this term right here, this paragraph, the more time premium, the higher the Vega is for an option contract. By that rationale, longer-term options will have a higher Vega number than shorter-term options. And I want to think about calendar spread traders. Okay, what is a calendar spread? And I'm going to save myself the trouble of plugging the Options Playbook and pulling up a calendar spread. But if you go to optionsplaybook.com and you pull up calendar spreads, what they are is I have a stock at 50. I sell the 50 strike near-term option contract. Right now that would be the August August just went away, so we got the September contract. And then I would go out and buy the October contract. So that would be a calendar. I got the 50 strike September contract that I sold, the 50 strike October contract that I bought. And a lot of times people will do this because they see that the September contract is trading at a much higher volatility than the October contract. And so they're doing the calendar to try to take advantage of this volatility skew. But what a lot of people don't realize is that if you look at this trade, this calendar is really long volatility. And you got to think about this. I sold the near-term option, and I bought the far-term option. As expiration approaches, let's say I'm dead on my calendar. I'm dead on, and the stock is right at 50. What happens to the near-term option? It expires in concept, worthless, and you are left long a call option at the 50 strike. What do you want to happen to volatility when you're long that call option? You want it to go up. So eventually with a calendar, you have to think of it as I'm eventually going to be a long call trader. So I want volatility to go up. And so if I'm doing a calendar spread to try to take advantage of a volatility crunch, I have to be aware that even though volatility might not drop as much on the back month as it does on the front month, that it might hurt my position more because the Vega was higher to start with. And once again, this is what I said. When we started this webinar, I was saying you have to think about what's really driving your strategy. And if I had a little bit more time, but we're running out of time here, I would actually do an example using our profit and loss calculator that will show you a lot of people think of a calendar spread as the Greek that really drives it is time decay, because you're trying to capture time decay. But when you first put a calendar spread on, it's more about Vega than it is about time decay. So now what is Vega? Well, if you have an at-the-money option contract that's trading for $4, the Vega is 0.10. And if the implied volatility was 60 and it went to 59, all right, your option should theoretically go down to $3.90. So in other words, a 1-point movement in implied volatility would make this option trade from $4 down to $3.90. But think of Vega on an entire position, on an entire strategy, and what you're trying to get that strategy to do. And always worry about it. You must, every time you trade options, any type of trade, even a long option trade, you should always think about Vega and volatility. I had a client call the other day on BP options, and the stock, like, here was the rationale. Here's a great little scenario, and then I'll talk about roll and we'll let it go. But I thought this was a great scenario because, once again, if you understand the Greeks and how they work, the longer-term options, the higher the Vega number will be than shorter-term options. So this client called up and was wondering why they were losing money on their BP LEAP option that went out over a year in time. And this was a little bit while back. I don't even know where BP closed at today, and I don't know where it was at. But bottom line is they bought an out-of-the-money long-term option, like a 50 strike, basically where 50 or 55 is where BP, British Petroleum, started before this whole debacle. And they bought that option contract. And thinking, I'll hold it for the long term, eventually they'll get this whole mess straightened out and the stock will go up. Well, as you may have known, they plugged the well and the stock ran up from 35 to 40. Guess what happened to that option contract? They lost money. The option went down in price. Why? What happened? Well, it was a long-term option and it was very susceptible to Vega risk, to the volatility coming down, and it was a very large number. So what happened was when the well got plugged and it got sealed, the implied volatility going forward on BP and all the option contracts in BP came crushing down, came tumbling down is the word that I wanted, came tumbling down, and that offset the 5-point move on BP on the actual stock wasn't enough to offset the loss because of Vega. So when you're trading longer-term options, and especially out-of-the-money option contracts, there's a lesson to be learned that Vega is a very important part of that equation. All right, so what could you have done to offset it? You could have spread, you could have bought a more at the money or basically in the money. There are many little things that could have been done to try to offset this risk. And you should have realized if you're trading BP that this is a real risk, that volatility crunch could possibly happen. And right now it's hard to say even what will happen going forward because there's still a ton of uncertainty as to what the total cost will be for the spill. And by the way, we don't make recommendations on anything, okay? But if I'm trading my FX options and I'm going out further in time, I want to pay attention to Vega. Okay.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.